Many businesses struggle with the difference between cash flow and profit. In this episode, Jim breaks down the difference, what to focus on when, how to think about cash, and gives real practical examples of places where he and I have both struggled and succeeded through these problems. I really think you're going to learn a lot, but we really want you to understand the value that's here. So watch the episode. Let us know if you have any questions. Thank you.
How you can be the greatest salesperson on the planet.
Welcome to the Rethink Sales Show. My name is Derek Kelly. I am joined by Jim Shorkey. And Jim, you've grown multiple dealerships. And something you talk about that fascinates me is many entrepreneurs struggle with cash flow and profit. What's the difference between those things, and what do you think of those things? What do you pay attention to most, and what do you pay attention to last? Talk about it.
Cash flow, we have to be careful with this terminology. So first of all, when we're running a business, and I don't care what the business is, the first and most important thing we need to understand is cash is king. Cash is king. You have to understand that cash is king. So that said, cash flow would imply cash is flowing in. Well, not necessarily. So the question I would ask you about cash flow, is it flowing in or is it flowing out?
Yeah.
So when we look at the operating report, the balance sheet, the income statement, mainly the income statement in this regard, is we need to understand that we got to bring in more cash than goes out. So the question, to answer your question, is it positive cash flow or is it negative cash flow? And is negative cash flow a bad thing?
Sounds like it.
But it's not.
Huh.
As long as you understand it.
Okay.
So if we're going to have a negative cash flow, what do we need to have in order to handle the negative cash flow?
Backup or savings, cash in the bank.
You need cash.
Right?
Cash is king.
Yep.
So if we have enough cash, we can handle the negative cash flow. And I'll ask you again, is negative cash flow a good thing or a bad thing?
It could be good.
It could be good, because we know that if we're going to expand our business, there's a very good likelihood that we're going to lose money during the expansion, because we have to get it up and running. We have to train our people. We have to advertise. We have to spend extra money to get the thing going. We also know that when we start a new business, let's assume it's a new business, you're going to expand. So we have business one, and you said growing another dealership, right? You said that, right?
Yep.
So we're going to go to a second dealership. What do we know happens when we start a new business, mathematically speaking?
Oh man, you lose money. You know better than me, but I bet for
Get more clear. What do we know happens, statistically speaking, when we start a new business?
It's going to put stress on the first business.
Deeper. I'm not going to go easy on you. You asked the question.
May go out of business.
Thank you. 70% is the failure rate of a new business. Now, if you don't know that, then you're making a huge mistake. Just because you're King Kong and you're going to go start this new business, the math applies to you. So there's a very strong likelihood that you're going to not make it with the second business. You have to understand that. Now, if you know there's a very good likelihood that you're not going to make it with that second business, shouldn't we be prepared for it?
Yeah.
Okay. And what do we need in preparation for the second business?
Cash.
Cash. So I would ask you, when you start this second business, I would ask you, businessman to businessman, what is your day? You're starting a second business now. Can you see that? And you've got your present business.
Yep.
What is your day supply of working capital right now in your present business?
Let's see.
Not your business. I don't want to know your
Sure,
business.
I'm just
in the business that we're hypothetically talking
Sure.
about. What is the day supply?
Sure.
Your day supply of working capital in your present business before you start this second business?
I bet you should have 3 to 6 months.
Nope. No, that's where you're wrong. That's where you're going to get screwed up. 3 months is the bare minimum
Okay.
for your business. 6 months makes you strong, okay? But not in a position to start a second business, okay? In order to start a second business, you should have, and this is just Jim Shorkey talking. You can take this however you want. I believe in my heart of hearts that you should have a 12-month supply of working capital. Now, do you know how to define working capital?
I don't.
Okay, I'll tell you how. Audience, please write this down. You take your total expenses for a given month.
Yep.
And you multiply that times 12.
Okay.
So just to make the math simple, if your expenses for your business is $5,000 a month, this is including rent, advertising, employee compensation, whatever. Remember you asked about cash flow. That's money out. So that's $5,000. That means we need to have $60,000 cash in the bank, and we are officially bulletproof. And how do I know we're bulletproof? Because we could go through 1 month and make no revenue, and we're going to spend $5,000, which means we now have $55,000.
That's right.
We're okay. We still have an 11-month supply of working capital.
Yep.
We go another month, no revenue. COVID hit, whatever. We're okay. Okay. Third month, we figured out a way to make $4,000 of revenue. We still lost money, but we only reduced our working capital account by $1,000. Now, this is overly simplified. I realize that. I have to be. This is a podcast, okay? But that is the essence of it, okay? So if your business is not operating at peak efficiency now, the biggest mistake you can make is to go start another business. I had a good friend of mine. We were talking about this. I said, don't do it. Don't do it. He said, oh, I can do it. I said, don't do it. You're making a mistake. And I asked him that question. Is your business right now operating the way at the best it could be? No. Let's fix that first. Because what do we know is going to happen? When we start this new business, we're going to have to put maximum effort into the new business in order to even survive. Yeah. What do we know is going to happen intuitively, speak from intuition, with the old business? It's going to degrade. Why? Because you're not on it. You've taken yourself out of the game. Yeah. You've lost a very key employee, yourself. So we know that the present business is possibly going to degrade unless we have what is called scale, which means we've got this thing so hardwired that we can walk. I would ask that question of you, Marshall. Your present business, you're going to get bigger. Lovely. That's a great idea. You're very ambitious. I respect that. Can you walk away from your business right now and have it not skip a beat? Then no, you're not ready. Yes? Okay. But still, you need to have the cash to withstand the fact that maybe your business will degrade. Let's not look at this thing with, oh, everything's going to be fine, everything's going to be fine. What if it does degrade? That just means you have less money. You're going to be draining the account on business A, and then business B is a struggle, to say the least. Cash is king, guys.
Yeah.
Cash is king.
That's good.
You have to have the cash to withstand the negative cash flow. And then as we're working on this, we work on the positive cash flow, meaning we're bringing in more money than we're taking out. And so the difference between that would be ostensibly net profit. And if we can retain that retained earnings, retain that net profit, what are we doing with our working capital account? If we can retain
it's growing as well.
It's going to go up, right? It's going to grow. Do you see the simple math of that? Now, again, that's an oversimplification. It's a little more complicated.
Because a lot of people focus on profit, and profit's important.
It is.
But cash is more important. And that was
Be
fascinating.
careful, Lord, because the profit is how we manage the cash.
Talk more about that.
When we're running a business, the number one reason that we're in business is what?
To make a profit.
To make a profit. Okay. Why is that the number one mission?
Because if you don't exist anymore.
Possibly, yeah. Unless you have a lot of cash.
Yes.
But we make a profit because that's what is called return on investment. Why would you go out and open up a business? It sounds really cool, doesn't it?
Yes.
I got my own business. It's not without its struggles. Trust me.
Yeah.
It's a tough gig.
Yeah,
Okay. The failure rate, 70%.
Yeah.
A lot of blood, sweat, and tears. It's a tough gig. So why would you go out and do this? You know what you do.
Right.
And you want to make don't buy into that baloney of you're gouging because you're making a profit. You have to make a profit. It's called fiduciary responsibility. You're responsible to the investors
To make a profit.
so that they get a return on their investment. Who is the investor in this particular case?
In a small business, it's usually the owner of the business.
It's
or the
you.
business partner, right?
Or a partner. And so why would you go through all this go on this arduous journey to not make a profit?
Yeah.
How does that even make sense? So once we make a profit, we pay everybody. That would be pre-profit. So we have a profit. We should be retaining that profit in terms of building up the cash account and just keep building. And then when we get to the point where we have the right day supply of working capital, which when you first started, you probably didn't.
Yeah, not at all.
You didn't.
No.
And it's hard.
Yeah, it's really hard.
It really is hard. And you've got to work on making a profit. Now, how do we make a profit?
So I think back to your conversations about value.
How do we make a profit? We have a business. I'm asking Marshall.
Selling stuff.
Selling stuff. How do we sell stuff?
We put the work on. Yeah, we make something and we sell.
Okay. And is it going to be good quality, bad quality?
Does it really have to be good quality?
Are we going to treat the customers good or bad?
Has to be, yeah.
So do you see what I'm driving at? We're here to take care of customers. No, we're not here to take care of customers. We're here to make a profit. How do we make a profit?
Take care of
By
customers.
taking care of customers. Let's not put the cart before the horse. Hey, we're here to make a profit and be very proud of that fact. That's called capitalism. And it's a good thing. Who in their right mind would go out and make a profit and make it really good and treat the customers really good and do all these great things and lose money by intent? You're missing the mark, guys. The objective is to make a profit. And the objective should be to maximize those profits within reason. And we do that by good products, creating value, good training, good service after the sale, good treatment during the sale. All those things that we know are going to give us a higher chance of selling something today. But the ultimate objective, and I want you to really home in on this, it's making a profit. That's what it is.
Did you ever have a dealership that maybe, this is just a kind of hypothetical, that maybe looked good on paper but actually wasn't when you got, was there ever a discrepancy there?
Yeah, sure.
What could that look like?
You look at it on paper, and you're talking the balance sheet and the income statement, the operating report, as it's called. It could be that the numbers were misleading. So that's why we do it's called due diligence. So we would get our accounting people involved and really look at things and say, this is a little fishy here. So now we know.
Right.
So get expert counsel involved. It could be that because we took the owner out of the equation, that business, even though we're coming in, the business degraded. So now we got to go to work on putting our stuff in as quickly as we can so that we can get it back up and running. The other side of it is the numbers could be misleading in another way.
Okay.
What might that be?
Man, I'm stumped. This is good. I don't know.
The other way might be we can do way better than that.
Oh.
And
so
now that
we're
we're in here,
undershooting ourselves. I've
now
done
that we're in here,
Yep.
we can.
Yeah.
We just found a gold mine
Yep.
because we're going to put our stuff in, which is better than her stuff,
Right.
his stuff, and we're going to train our team on our processes. And it went way better than we thought it would.
Yeah.
I've had that experience too. I've had both.
Yep.
And when it's good, that's obviously fantastic. When it's bad, the number one thing we got to do when it's bad is we got to execute a pivot, P-I-V-O-T. If we look at it, we figure out what it is for real now. We figure out what we want it to be. That's the goal for real. And then we seek expert counsel to figure out how to get there. Now, maybe, for example, let's say, for example, in real life, we have these different dealerships. And this is our first time of working with Chevrolet. Now, the kids have 2 Chevrolet dealerships. This is after I got out.
Sure.
But maybe possibly Chevrolet is different than Kia.
Yep.
So we got to learn how to do their stuff. So would it be a good idea to call a good friend of mine who is a very successful Chevrolet dealer and say, hey, how are you doing what you're doing?
Yes.
And I get my list.
Right.
And he says, Jim, one thing I see you're doing there, that's not how you do it with Chevy. You need to stop doing that. So we get our to-do. It's the same thing all the time. Rethink You
Yeah.
2.0. So if it's not as good as we thought it was going to be, we need to pivot. If it's better than we thought it would be, we need to practice gratitude.
Man, this is good, Jim. I've learned so much. You can just hear Jim talking about the difference between cash flow and profit and how they work together and the ups and the downs. Understanding the audience, a Chevy audience may be slightly different than their desires in a vehicle than those who are interested in Kia, right? It's just such fascinating and good advice for those of you. So we know that many of you are salespeople, but we have others of you that are entrepreneurs and you're trying to figure out what does your business model look like. That's why I wanted this conversation with Jim today is what are some of these things that we always talk about and how do we do them well?
I brought my special mug today. See if I can pick it up without. My arms are shaking, not I did physical therapy this morning. So I'll close this segment out with my mug here. It says, I can explain it to you, but I can't understand it for you. I picked my mugs with intentionality. I didn't know what Derek was going to ask me today. I didn't. I have no idea. This is all extemporaneous. Am I right?
Yes.
Marshall, did I know anything about this?
No.
I picked this mug out because I knew Derek was going to ask me questions that I didn't know the answer to. I didn't know the question. I know the answer. Hopefully I do. But it says here, I can explain it to you, but I can't understand it for you. If you don't understand cash flow, you need to get a book. You need to go to YouTube. You need to talk to somebody like me. If you don't understand it, wow, good luck with that. That's like putting a blindfold on and going out in the middle of the night and walking around. Bad idea. Bad idea.
Yeah.
It just is. Take the blinders off, gang. So I can explain it to you, Derek, but I can't understand it for you. So did I explain it to you?
Yes.
Do you understand it?
More and more. Yeah. I think I understand it. Yeah.
It ain't over till it's over, is it? Yeah. We're going to keep working at it.
Thank you, Jim. Thank you, guys. Please ask us any questions that you have. We'd love to stay
I
connected.
love your questions.